support and resistance, but you want to find the nearest support and resistance. So let's get started on something else. I'm very excited for tonight's lecture. We're going to be talking about Japanese candlesticks. So we've already done a little bit with candlesticks, but we're going to dive deeper into what they are, how do we use them, and how can they help our trading. So as you all know, this is an example of a candlestick chart. This is different from the line chart or the bar chart. So let's talk about the history of candlestick patterns. So we have to go all the way back to 18th century Japan with Munehisa Hama, and he lived in the 18th century, and we call him the father of price action because he actually created these candlestick patterns. So he was born into a wealthy family, was very familiar with the market, and he traded rice futures at the Dohima Rice Exchange. And he is one of the most legendary traders who ever lived. He's said to have made 100 profitable trades in a row. He also founded the first major hedge fund, and the Japanese government recognized his talents, and he was made financial advisor to the government of Japan and given the honorary title of samurai. So he observed all the different psychology and emotions that were happening in the market, and he recorded them in the form of candlesticks. So this is a quote from him. "The psychological aspect of the market is critical to trading success." That's a quote from Munehisa Hama. And what candlesticks do is they tell us the psychology between buyers and sellers. Who is in control? Who's not in control? Who's being fearful? Who's being greedy? So just like technical analysis, candlestick analysis will tell us the psychology and emotions that are at play in the market, because that's what the market is. It's all emotionally driven. So what are some of the benefits of candlestick patterns? Well, they're going to provide you more information than your typical line chart, your bar chart, and it's going to add that extra layer, that extra depth to your technical analysis. And when we trade with candlestick patterns, we can find early signs of reversal. We can say this trend is coming to an end, sellers are stepping in here. This downtrend is coming to an end, buyers are showing up here. So candlesticks are going to work on any time frame and in any market, but just like technical analysis, the candlesticks in the higher time frames are going to hold a lot more weight. And now, what is going to really change your trading is that when we combine these Eastern Japanese candlestick techniques with our Western technical patterns, our ascending triangles, our double bottoms, then we have a lot more information at our disposal to make sound trading decisions. So you can be one heck of a trader if you combine your candlestick analysis with your technical patterns. So what is a candlestick? So a candlestick is going to show us the opening price and the closing price. And it's also going to show us the highest price of any given time period. And it's going to show us the lowest price of any given time period. So this green candlestick, it closes higher than the open. So with every green candlestick, the open is going to be at the bottom of the body. So we see these wicks here, we call them shadows. Those are not the close or the open. So the body, the top of the body is going to be the close. This is, the stock market closes, at 4 o'clock Eastern time. This is the price that it closed at. It may have went up here, but then it closed at this level. And this is where it opened, and it might have been, and it dropped lower, but then it pushed it all the way back up to the highs, and then it closed at the top of the body. And then for the opposite, for a bearish candle, these are the red candles, the top is the open. So at the open of the day, when the stock market opened, this is where the price opened at. So at 9:30, price was here at the top of the body, and then by the end of the day, it closed at the bottom of the body. And then these wicks, these shadows, those are the highs and the lows of the day. So the benefit of trading candlesticks is that we get two pieces of key information: the open and the close. Whereas a line chart is only going to give you the close. So if you remember two things, it's the most important prices of the day are the open and the close. So a little bit more about labeling these things. So yeah, we can call them shadows, wicks, and this is the real body. So this juicy stuff in the middle here, that's the real body. These little lines on top and on bottom, we can call them lower shadows, upper shadows. So at the top here, this is the highest price of the day. And then at the lower of the lower shadow, this is the lowest price during the time period. The lowest price of the day. And for the bearish candle, we open up at the top of the body. When the stock market opens, the price opens at this price, at the open of the real body, and then it closes at the low of the real body. And then the highest price is the top of the upper shadow, and then the lowest price is the low of the lower shadow. So green, bullish. That means price went up. Red, bearish. Price went down. So for a bullish candle, it closes higher than it opens. For a bearish candle, it closes lower than it opens. So let's talk about, so not every candlestick is created equally. So there are strong candles, there are weak candles, there are indecisive candles. So this example here on the left, this is what we call a bullish Maribozu. That's a strong candle. So that shows that buyers were in control the entire day. So it closed at the high of the day. So that is extremely bullish. Now a weak candle, like this candle right here, it shows that the buyers are losing momentum. So they bulls push the price all the way up to here, and then maybe it faded off during lunch or something, or at the end of the day, and then closed down here. So buyers had momentum, but then sellers stepped in and pushed this thing down towards the lows. So we have strong candles and weak candles. So as a general guideline, the longer the candle body, the stronger the signal. So let's start with the bullish Maribozu and the bearish Maribozu candles. These are the strongest signals that you can get. This is the strongest kind of candle. So the bullish Maribozu, like I showed before, is the strongest candle you can have. So it has a large body and no upper or lower shadows. So this indicates buyers have taken control and they never let price drop below the opening price. And the price closes at the high of the day, which is a very bullish signal. So buyers had momentum. They kept this thing going up. Each person was willing to pay higher than the last guy, so buyers saw value to stepping it up. Maybe there was good news. Maybe it's breaking out over a key level, bouncing off support. So a bullish Maribozu is one of the strongest signals that you can get. So how do we trade it? So it's all about the next candle. So a lot of candlestick trading is about what happens next that decides your decision. So we're going to buy when the candle goes above the high of the Maribozu. So this is an example of a Maribozu in the context of a chart. So we're in an uptrend, and then buyers just hit the gas. So it recognized this long body. So in relation to the rest of the chart here, this is one strong candle. And as you can see, price continued upward. So when you see the Maribozu candle, you can kind of assume that price is going to keep moving in that direction. So here we have a Maribozu over downtrend resistance. So that could possibly be a buy signal. Now, how we play it is if the next candle goes above the high of this Maribozu, we can look to go long. And we're going to put our stop loss underneath the low of the Maribozu. So this is the Maribozu. We had buyers really stepping on the gas, and we had double confluence with a trend break, and buyers are pushing this thing up. So that is the beginning of a new uptrend. Now, a con about this, depending on your trading style, depending on your risk management, this stop loss is a little wide for me. So if we're entering here, but our stop loss is here, it's a little wide. But it was a good play regardless. There's other ways to quantify your risk, so just keep that in mind. So you have a high probability of it working out, but if it doesn't work out, you might have to take one on the chin. So here's an example of a bullish Maribozu that closed over resistance. So we had sellers holding it down at this level, and then bulls take control over resistance, and then it closes at the high of the day. And then, we put our stop loss under this candle. So as soon as price goes above, we can look to enter calls, buy contracts, whatever, buy shares, and then just ride the uptrend. So you never want to buy a candle just because it's this kind of candle or it's that kind of candle. You want to buy at areas of value. So like here, we had this resistance, and what happens when we break over resistance? We're going to get a breakout, or traders are going to be looking for a breakout. And so that's what attracted all these buyers. We finally cracked this level, and then as shorts get stopped out of their position, it adds fuel to the fire. So they're buying, they're getting stopped out. Bulls are stepping on the gas, and they're going to push this thing higher. All right, so we've got another example of a bullish Maribozu. So we've got a long candle body, and we've also got resistance up here. So this Maribozu candle that happened, it gives us a clue that buyers may push the price over this resistance. So we're going to take our entry right above the resistance, because we knew that usually Maribozus continue in the direction of the trend, and put our stop loss under the low of the Maribozu. And obviously that is kind of a huge stop loss. So maybe you could apply like a moving average or something to increase your risk to reward. But the textbooks say, put the stop loss under the candle. So we'll just keep it that way for now until we go into different techniques for risk. Okay, so every candle has its opposite candle, and the bearish Maribozu is the strongest bearish candle. This means sellers were in complete control. So this, has the large body, relatively no upper to lower shadows, and price is going to close at the low of the day. So bears stepped in right when the market opened, and they pushed this thing all the way down today. I don't know if any of you guys were watching the market today, but the NASDAQ was down like 5%. So today, if you go back and look at the candle from today, it is a massive bearish Maribozu candle. Bears were in control the entire day. Bulls didn't have any steam, and they were just getting rolled over. They're getting ran over with a semi by the bears. So it's similar to how you play these. You want to buy when the next candle goes below the low of the Maribozu. I'm going to change it in the PowerPoint. And then put your stop loss over the high. And then, the stop loss might be pretty wide. So we've got a bearish Maribozu here. Long candle. Small wick. And we put our stop loss somewhere above. Not right above, because it could get easy to stop out that way. But a little bit above the Maribozu, and then as soon as price goes below, we enter. So we would have entered on this candle here, and then a fierce downtrend ensued. Let's do another example. So we have a trend crack right here. So sellers have managed to break this uptrend, and we have our bearish Maribozu, and then as we can see, price goes lower. So sellers have overpowered the buyers enough to reverse the trend, and that indicates price will most likely continue lower. So when it comes to bearish candlesticks, think about it as like gravity pushing the buyers down. So gravity is pushing the price down. So that's how you should think about bearish candlesticks. So here for the bearish Maribozu, that's a ton of gravity. Or think of like someone pushing you down. And we've got another trend crack right here. We've got huge bearish Maribozu. But yeah, the stop loss is very wide. You wouldn't have entered right here on the bottom because your stop loss is just too wide. So if you see a bearish Maribozu, it can mean, if you're already in a short, no reason to sell if you see a bearish Maribozu. You don't always want to enter on the Maribozu itself. If you are on a smaller time frame, you could have entered at the crack of the trend and then rode the bearish Maribozu down. I wouldn't really enter right here because your risk to reward just isn't there. Whoa, whoa, whoa. What about this bearish Maribozu? It's got a wick. So it can't be a Maribozu, right? So the thing about candlesticks, you have to be flexible. So you got to allow some wiggle room. So small wick is fine as long as either side was in control the majority of the time period. So price opened here at the high. Bulls tried to step it up a little bit and then got slammed all the way down to the low of the day, and that's where they close. So sellers are in complete control with the bearish Maribozu. Don't worry about wicks or anything. The main component is that it has a long body. So in comparison to the rest of the chart, the Maribozu candles are going to have huge real bodies. Okay, so let's talk about our second candlestick pattern. And these are reversal candles. And so we're going to talk about the hammer and the hanging man. So the hammer has a small real body and a long lower shadow. So these happen in a downtrend where sellers push the price lower, but then buyers decided to step it up. They saw value and they're going to push price all the way up to the high of the day. So these are found in a downtrend, and that is a strong signal. And the hanging man is the opposite. So the hanging man is the same candle as a hammer. So if you were looking at them, they would look the same. But it's found in an uptrend. So buyers push it up from the lows, but sellers are starting to step in. So we'll go over that in a second. Let's talk about the hammer first. So we find hammers in a downtrend, and it's a potential bullish reversal. So how to identify a hammer candle? This lower shadow has to be twice the size of this body. So remember, the body is from the open to the close, and then this line is the shadow. So as long as the shadow is twice the size of the body, we can call that a hammer candle. So the color doesn't matter. This could be red, this could be green. All that matters is that bulls push the price up to close near the high of the day. So how do you play these? It's all about the next candle. So a lot of these bullish patterns, you buy when the next candle goes above the high. All right, so we've got our hammer candle here. Price was kind of in a downtrend here. And then buyers push the price up from the low of the day to close near the highs. So this may indicate a reversal of the downtrend. So if you were going to play this hammer candle, you would enter when the next candle goes above the high of the hammer, and then you put your stop loss under the low of the hammer. And then here, this is where a new uptrend ensued. So let's do another one. So we've got a hammer candle here, and I mean, why do they call them hammers? I mean, they look like a hammer. They look like a big meat cleaver or something. So we can see here, price was in a downtrend, and then as soon as we go above the hammer high, price starts to move in the other direction. So these are good reversal signals. I don't know if I'd really take a hammer by itself, but there are people who solely trade candlesticks, but you want to mix it with like trend break or some kind of other, if it's bouncing off support, something like that. So let's talk about another hammer. So this one actually has a little bit larger of a real body, but the shadow is still pretty long. Maybe it's not twice the size of the real body, but all that matters is this wick. So this wick is propelling price in an upward motion. So buyers, they're just kicking the sellers out. They're saying, we're taking this thing higher. It's like, imagine if it was like boxing. The buyers are going to give the sellers a big uppercut to the chin, and that's what this wick is. So they give them the uppercut, boom, their head goes up, way up, and then so does the price. So here we had double confluence of an actual trend break with the hammer. So as soon as price breaks above the hammer and the downtrend, we can look to enter and put our stop loss somewhere underneath the low. And then here's a perfect example of price entering a new uptrend. So these really are great patterns. Now let's talk about an invalid hammer. What would invalidate a hammer candlestick pattern? So we have a hammer right here, but then price actually went below the low of the hammer candle. So this invalidates the hammer pattern, and sellers have taken over. So the thing about trading hammer patterns is that, if you're really aggressive and, you just buy right when price breaks through the high of the hammer with your stop loss below, you're going to get stopped out quite a bit. But for the times that you do win, you're going to make, 10 to 20 times your risk. So it just depends on your trading style, your risk management. Aggressive traders, they get stopped out a lot, but when they win big. So use that, keep that in mind when you develop your risk strategy. So what is the hanging man? So the hanging man looks the same as a hammer, but there's a kind of a different psychology behind it. So hanging man is found in an uptrend. So we're going up, 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 and then we get this hanging man, and it looks like a hammer. So this is a potential reversal signal. Just like a hammer, the lower shadow is twice the size of the real body. The color doesn't really matter, but a red candle is going to be more bearish than the green one, right? So this is going to close near the highs, little to no upper shadow. So most people are thinking, but that means the wick means that sellers, they're losing, right? For that time period, yes, they did. Buyers stepped it up and they pushed price to close near the highs. But this wick indicates that sellers, they're interested in this. So they're interested in going short. They might have lost the battle, but now they're starting to show up. They might win the war. So if we see a hanging man, we might not look to go short just yet. We might see a hanging man and think, now it's time to scale out of my long position. let me sell a couple contracts here, or let me exit because it looks like sellers are likely to come into this market. So let's look at some examples. So here we've got a green hanging man. So we're at the top of an uptrend. So we've got this hanging man candle right here. So this indicates we actually have two hanging men right here. So we actually are seeing sellers starting to come into the market. Even though buyers push it up from the highs, it's just the looming threat. Because if we look up here, we have pretty strong momentum. Buyers are pushing this thing up. But as soon as we see these wicks on the hanging man, we see, bulls might be starting to lose a little bit of steam. They're losing a little bit of momentum. So how would you play this if you were just playing the candlestick? So when price goes below, you can sell short and then put your stop loss above the candle. In this example, it makes more sense to put it above the high of this candle. And then that's a very strong, or I'm not going to say strong, but that is a reversal pattern. And now here's another example. So we've actually got two hanging men right here. And the thing about candlesticks is the names for them, whether they're ominous or they're positive, you get an idea, and that's how you remember them. So, hanging man, that doesn't sound good. So the stock might be ready to die. So we've got our hanging man right here. So me personally, I don't like to go short in an uptrend. That's not my style. Some people do it successfully. It's just not my cup of tea. So if I see a hanging man, I'm not going to think, oh, I need to go short right here. The market is about to sell off. For me, it's more of a clue. If I'm in a position and I'm bullish and I see the hanging man, I might think, time to sell a couple contracts, time to scale out. And here's an example. We've got another example. We've got this lower wick, and then the rest is history, right? The price tanked. So I actually like hammers more than hanging man. I included hanging man because people usually pair them together. But like the psychology of the hammer, it makes more sense to me. So here we even kind of have like a support back here. So it bounced off support and buyers pushed it towards the high of the day. And then, you get that bounce, you get that rip and run. Price is going to recover from that. Whereas the hanging man is not as successful, it's not as reliable as a pattern. So that's why I don't use it to ever actually short anything, just as clues. And that's the thing about trading. You look for clues. What is the trend telling us? What is the market structure telling us? What is the volume telling us? What is the candlestick telling us? Are there any patterns? So we piece all these pieces of information together like we're some kind of detective, and then we can make buying decisions based on our analysis of all that different data. So let's talk about the shooting star. Now this is actually an extremely reliable pattern, and this is actually a bearish reversal pattern. So if you see a shooting star, you might want to get out. So in the book I read about candlesticks, it said that in Japanese culture, a shooting star means misfortune. So it's a bad omen. If you see a shooting star in the sky, it means something bad is going to happen in your life. So in candlestick analysis, the shooting star tells us that the stock is about to head lower. So here, the shooting star actually has a very long upper shadow and a small candle body that closes near the lows. So this is found at the end of an extended uptrend. So this is a bearish reversal pattern, and the upper shadow has to be twice the size of the real body. And as a general rule, the longer the wick, the greater the rejection. So the psychology is that buyers push the price up from the open all the way up here, kind of steamed out. They're getting tired. and then sellers step in aggressively and then push price down so that it closes at the lows. So think about that as gravity pushing down the stock or whatever you're trading, coin or whatever. I mean, they call it a shooting star because maybe it looks like a shooting star. I don't know. Not really, but sure, we'll go with it. So sell short when the next candle goes below the low with your stop above the high of the shooting star. So here we've got a shooting star, and the shooting star is kind of almost the opposite of a hammer. So we've got long upper wick. So basically turn the hammer upside down. So, if we've got a hammer right here, turn it upside down, what do we've got? We've got a shooting star. So we go short under the low of the shooting star. And I mean, it just depends. I mean, similar to hanging man, it can be used as a clue to maybe exit your long position. You don't always have to go short. And that's the beauty about reading candlesticks. All right, so yeah, the color doesn't really matter on a shooting star. This one is green. All that matters is it has this huge upper shadow, huge upper wick. So we'll put our stop loss a little bit above, and we'll go short when price goes right below. And then, boom, the trend is over. So when you see a shooting star in an uptrend, it indicates price is losing, or the buyers are losing momentum, bulls are running out of steam, and sellers are coming into the market aggressively. All right, our last example, we've got an uptrend, and that's the key. So if you look at candlesticks kind of in the middle of trends, that's kind of meaningless. I mean, depending on the candlestick pattern. But for shooting stars, you want to look for these in an extended uptrend. So like here we had a shooting star, didn't work. I mean, it worked for a day, but that's okay. So here we can see in hindsight that the trend ended right as the shooting star appeared. So let's talk about dojis. So the thing about dojis is that they're going to open and close at the same price. So the open and the close are near identical. So here we've got just a plain old doji. It looks like a plus sign, and there's no body, or it's just a very small body. So the upper and lower shadow are roughly equal in length. This upper shadow and this lower shadow are roughly equal in length. And this shows indecision. So this is showing that there's a tug of war between the buyers and sellers and that they are in equilibrium. So neither one is getting the advantage over the other. So the color doesn't matter, and there's usually no color anyway. Usually it's just a very thin body right here. So here we've got a doji. Just look for a plus sign. We've got one right here. We got the plus sign. We've got one right here, plus sign. Now in the middle of a trend, does that really mean anything? Not really. There are doji patterns that we'll get into, like morning star doji and evening star doji, but we'll save those for next time. I want you guys to be able to identify your single candlesticks just at first, because I don't want to throw 50 different patterns at you at once. So we're just talking about the important ones for today. So yeah, the longer the shadow, the stronger the rejection. So shooting star, the longer the shadow, bulls are getting rejected. Higher prices are getting rejected. The hammer, the lower shadow, lower prices are getting rejected. So the longer the wick, the stronger the rejection. So think of it as gravity. So let's talk about the gravestone doji. So the gravestone doji is near identical, close and open, and this is similar to the shooting star. You could even kind of call them the same thing, but it just shows that price was pushed all the way down from the high of the day to the open. So if you're in a stock and then price is all the way up here, at this point before the market closes, it's a bearish Maribozu or a bullish Maribozu, and you're thinking, oh yeah, I'm about to be rich. We've got a bullish Maribozu. Price is definitely going to go higher. But what happens at lunchtime? They take this thing all the way back to the lows. So that's not something you want to see if you're a swing trader, if you're a day trader, on any time frame. If you're bullish and you see either a shooting star or a gravestone doji, you might start heading for the door. So think of this wick as gravity pushing the price down. They're holding the buyer's head underwater. So here we've got the gravestone doji. I didn't put too many examples because it's basically the same thing as a shooting star. So you got this up move, and then what marks the end of the up move? This gravestone doji. Then you got this massive bearish Maribozu candle. So bulls ran out of steam. Bears took it from the high of the day to close near the lows at the open, and then the rest is history. So always think about who is in control, buyers or sellers. So if we look, this candle, bears are in control. Look at this. I guess you could kind of call that a hammer, maybe. Buyers are in control. Buyers are in control of this whole uptrend. And then what happens here? We got a shooting star. We know that the trend might be exhausted and that bears are likely to step into the market. So here, we've got long candles with long bodies that shows strength. And then, we've got this candle that shows strength on the bear side and weakness on the bull side. So it's not about memorizing 100 different names for every single candlestick pattern. It's what the candle is telling you. If there's a long wick on either side, it means the opposing side isn't as strong for that particular time period. So the dragonfly doji is kind of similar to a hammer. So it has the near identical close and open, just like any doji does. And it has a very long lower shadow. So what does lower shadows mean? It means that buyers aggressively push price up from the lows. So this is similar to the hammer. Think about the lower shadow as an archer. And then this wick, this shadow, that's his arrow. And so he's shooting his arrow into the sky, pushing price higher. So that's kind of how I think of the dragonfly doji. So we're going to use these bullish candlestick patterns to buy at support, buy pullbacks. We don't want to buy in the middle of a range. We don't want to buy in the middle of a trend. We want to buy at areas of value. So here I made this cheap little graphic. We've got an archer. She's shooting her arrow into the dragonfly doji, and boom, her arrow sends it all the way to the soaring into the sky into a new uptrend. So some candlestick rules. So like I was talking about before, you don't want to just buy every candlestick you see. I did that when I first started trading. I thought I knew everything about candlesticks, and I lost a lot of money. I lost like 70 grand. So combine your candlestick analysis with traditional Western technical analysis. Buy bullish candlestick patterns at support or on a breaker of resistance. Sell bearish candlestick patterns if it's rejecting resistance or breaking support. So don't really try to do anything in between. Like I said, in the middle of a trend or in the middle of a consolidation, these candlesticks are kind of meaningless by themselves. So always consider context. If you get like maybe a medium-sized Maribozu bull flag breakout, you can kind of safely assume that you have, a pretty good chance, a pretty good risk reward that price is going to continue upward. So also be flexible with the pattern recognition. There's the things that textbooks tell you what it is, but they don't always look like the textbook examples when you are actually trading these things. So, if the bearish Maribozu, has a lower, has got a small wick, it's no big deal. All that matters is, the candle body. So the names aren't all that important. What matters is what the candlestick is telling you. Who's in control? Is it buyers, sellers, indecision? And then, like all trading techniques, the candles are going to have more significance on larger time frames. So wait for candles to close to generate any kind of signal. So like I said before, so like this dragonfly doji, when price was all the way down here, that would have actually been a bearish Maribozu. So you don't want to get excited and say, well, this is a bearish Maribozu, and it's 12 o'clock. I'm just going to assume that price is going to continue lower throughout the day. So I'm going to sell short early. That's a big mistake. You want to wait till the next day, because look what happened. Maybe you open up the short position and then you went and had lunch, you come back to the market, and then you see buyers have actually pushed the price up into a dragonfly doji. So your whole bearish thesis was actually destroyed. So it's about staying patient and waiting for the next candle. And yeah, so definitely wait for the candles to close. And if you've been day trading long enough, you've been swing trading long enough, you know that. Wait for the candles to close. Otherwise, you jump the gun and you can get destroyed easily. All right, so I have an assignment for you guys, and there is a quiz too. I dropped the link for the quiz in the bootcamp chat. So what I want you guys to do, I want you to go to finviz.com. It's a site that we've used in the past. You should probably recognize it. So we're going to go to Screener. We're going to click out of this dumb ad. And then we're going to go to All, right over here. Let's see, what did I tell you guys to do? We're going to choose NASDAQ as our exchange. So that's actually the first option right here. So we're going to switch the exchange to NASDAQ. And then here, all the way on the right column, there's a candlestick pattern selection. So let's choose a long lower shadow. So what are long lower shadows? Those are going to be hammers and dragonfly dojis, right? So we're just going to go look through all these different charts. See, we've got ACST, looks like a hammer in the works. Actually looks like a hanging man because it's at the top of an up move. We've got a hammer on ALRN, hammer on ATLCP, hammer on BSVN. So I want you guys to go and look through these. I want you to pick like a couple. And I've got different things that I want you to look for. I'm going to find 2 shooting stars, 2 hammers, and they actually have an option for hammers. So if you go to candlestick again and then click hammer, it's going to show you all the stocks that have hammers in the NASDAQ. So the only way to learn candlesticks, you got to get your hands dirty. So you can only watch so many videos, you can only read so many books. You have to interact with the charts, and that's how you memorize them. I don't expect you guys to memorize 100 different chart patterns by next week. So that's why I give you the advice of how to read the strength of the candle. Because, the names, do they really matter? I know, you'll learn them eventually. You'll learn your morning star, abandoned baby, evening star, stuff like that. But for right now, at most of your levels, Long lower shadows and long upper shadows are going to be extremely powerful in your trading. So like if you see a long upper shadow and you're long, you're playing calls, get the heck out. And I think I had one more thing. And yeah, there is a quiz. So I want you guys to go to Tesla Daily and then find two bearish Maribozu candles. Shouldn't be hard. I see like like 5 or 6 just right here. So just go in, do like a little arrow. See, we can call this a Maribozu right here. Long body, open, close. We close at the lows. So I want you to find some Maribozus. I want you to find some bullish and some bearish, and then upload those to the Google Classroom. And I also want you to find two bearish Maribozu on the forward 5-minute chart, because I know a lot of you guys are going to be interested in day trading. And you can see how patterns work on the 5-minute chart on the lower time frames. So even on a lower time frame like this, see what do we got here? We got 3 hammers in a row. So each time, let me zoom in. Each time bears are trying to push this price down, buyers are rejecting those lower prices. Reject it. And then what happens? Uptrend begins. And this is going to take some playing around with. It's going to take some working around with. I didn't learn candlesticks overnight. It took me months and months. I tried not to overwhelm myself, with 100 chart patterns. What I did was I found, one of those cheat sheets. There's like candlestick patterns. Just go ahead and Google candlestick patterns and you'll find some great cheat sheets. And then I put it as the desktop wallpaper so that every time I open my computer, I'm digesting these patterns. And that's what I did for technical analysis patterns too. I put them as a wallpaper on my phone so that every time I open up my phone, I'm looking at the patterns, I'm internalizing them. So that way when I go into a chart, I can say bearish Maribozu, hammer candle, shooting star, bullish harami, bearish harami, tweezer bottom. So we're actually going to do another lesson on candlesticks on Saturday, and we've got some exciting stuff that I want to teach you guys, like the 3-bar and the 4-bar play, and I'll teach you about inside bars and the harami and the bearish and the bullish engulfing. So for right now, just stick with these basic patterns: dojis, Maribozu, hammer, hanging man. And I wouldn't even really worry about the hanging man too much. Hammers,